Are you wondering about mortgage refinancing? Are you coming up to the time where you have to refinance your mortgage? The term is coming due, and maybe you're a little bit concerned because mortgage rates are higher than what you originally had on your previous mortgage. Perhaps you're in that stage of life where you're looking to retire and you're wondering how you can use the equity in your home to live the life that you want to live. Mortgage refinancing can seem a little bit overwhelming, but today we're going to break it all down with our guest, Walid Mutahar, who is a mortgage agent with Garland Mortgages. And we're going to be talking about mortgages and refinancing, everything you want to know and everything that you need to know. So I hope you enjoy the show.
So what would be the difference between doing a refinance and putting a line of credit in place? Are they considered the same or are they different?
Yeah, so they're actually considered one and the same. A line of credit is just a form of that equity takeout. You can take it as hard cash, meaning increasing your mortgage amount. You can take it as a line of credit, that is deferring the withdrawal until you actually need it at any given point in time, or just, having it there as a safety net. You can also do like a reverse mortgage, which is kind of a combo of the two, more, I would say closer to a line of credit, where you can borrow up to your approval amount, your maximum amount, whenever you need to.
So if you were to do a line of credit, you wouldn't start paying payments until you actually pulled from it. So if you were to do it as a second mortgage, meet your using the money right away and you'd start your payments right away?
Exactly. Yeah. So once that money's deposited into your accounts, whether it be from withdrawing from a line of credit or from the new second mortgage, you're paying interest on it right at the get-go. Think of it as your credit card. If you use your credit card, all of a sudden there's a balance, you're going to be paying interest over the next month. But if you don't use it, it just sits there available for future use. So that's a definite benefit of the line of credit. The one big thing is if you know you're definitively going to be using that money right away and you're going to be carrying your money on a line of credit, it doesn't make sense necessarily to have it on a line of credit because the only payments you're going to be making are interest-only payments. So you won't actually be bringing down the balance of the line of credit. It'll kind of sit there in limbo, and each month you're only paying the interest on it. It's almost better from a financially prudent perspective to put it into a mortgage if you're able to handle that cash flow.
Okay, so here's a question. So you can do a mortgage and you can do this line of credit. Line of credit, your payments are lower because it's interest.
Right.
However, isn't a line of credit open that they can do lump sum payments and pay down?
Yeah, it's not to say that some mortgage products aren't either, but a line of credit is definitely the most flexible way to borrow. It depends on your needs. If cash flow is a concern, then for sure a line of credit is probably the best bet because like you said, you're only making those interest payments. But if you're looking to aggressively pay down your mortgage, it might not be the best option depending on how much excess cash you have.
So again, this is where it's prudent for a buyer to come and sit down with you as a mortgage broker so that you can really find out what their situation is, what their cash flow is, what their intentions, their time span, what it is that they want to do. And then you can advise them, I guess, as to what the best product would be. And the best product, as we've spoken before, isn't always necessarily just interest rate. It's the options that come with it and how they fit into their life.
Exactly.
So if a client is self-employed and they don't claim a lot of income on paper, can they still qualify for a refinance?
Yeah, so it's funny. I had a doctor yesterday. She pays herself from her corporation as a dividend. And she only takes a nominal salary, maybe something like $60,000 a year. But her business is making like over $1 million a year, an absurd amount. So she goes to her bank. The bank looks at her T1s and her NOAs, and they're like, the most we can get you is $100,000, which I thought was hilarious because you're looking at somebody who's like, at the top of society in a lot of people's eyes. size, so super well educated, and they can't even qualify for a mortgage. So yes, the short answer is yes, you can definitely get a mortgage if you're self-employed. It might look a little bit different though. So what I mean by that is instead of looking at your tax documents to determine what your usable income is, we're going to actually look at your bank statements. And from your bank statements, we're going to derive based on the business's, gross revenue or their deposits versus their net expenses. We're going to determine what the usable income is from the statements. And then it's going to tell a more true story of what you actually earn. Because let's be real, a lot of self-employed individuals are trying to avoid paying heavy taxes, especially when you're making that kind of money.
And so if someone was looking to refinance, what is the maximum amount that a lender will give them if they were refinancing their existing property?
So this goes back to as well when the stress test came into play, that B17 rules and regulations. Now the maximum loan to value an institutional lender, and when I say institutional, I'm talking about, your bank lenders or your monoline lenders or your credit unions, not the private guys. The maximum loan to value is up to 80% of the lending amount, 80% of the property's value. So we'll generally get an appraisal to determine what the value is, and you can get 80% of that as a mortgage. There are private institutions that'll let you go over and above that, but, especially in a declining market, those could be quite risky.
And so if somebody had property A, they had 80%, and they bought property B, now they want to buy property C, how does that work? Are they able to do then 80% of property C or?
Yeah, so we can go 80% on properties A, B, and C. So the idea is if you bought property A, and you've had that property for 5 years, and at the time you took it to the maximum, then maybe we'd move over to property B, see how much we can get from there. And if we couldn't get enough, we'd go back to property A, because there are ways to contest an appraisal. I mean, the market is so dynamic in and of itself, as I'm sure you would say, a house is only worth what somebody would pay for it. So all of a sudden, if a home down the street goes for sale and it's well above the traditional area or traditional prices, maybe we can use that home as an example to bump the appraisal value. And that's all stuff, good relationships the mortgage broker should have, you could take advantage of.
And in terms of buying subsequent properties for investors, for example, how many properties will they pull from down the road? Is there a limit where they say after you've done 3, no more, or is there such a number?
Yeah, so it'll vary from lender to lender. Your traditional big banks, TD, Scotiabanks, they're going to be in and around 5 properties. So that would be 5 investment properties, 1 primary residence, and 1 secondary home for a total of 7. But generally speaking, some lenders are going to allow you to go up to 10 doors. Some lenders will have no limit, but they'll only use a certain amount of rental income from a certain amount of houses. For instance, you have 20 houses, but we can only use rental income from 5. We have to just ignore the other properties, but include all their payments.
So that was leading up to my next question. So when they are looking to refinance another home, what's the process? They obviously have to qualify for it. It's their income. Plus, if they've got rental properties, all of that rental income or partial of that rental income, you said it could be capped at a few properties, or does it just totally vary on the lending institution?
So it totally varies on the lender, but generally speaking, the most common investor I would say I see has 1 or 2 rental properties. So for those investors that fit in that bucket, we can use all of the rental income that's provided. How we use it is going to vary from lender to lender. So for instance, some lenders will take 50% of that rental income, include the mortgage payments, the property taxes, condo fees if applicable, and heating costs, and add that 50% of the rental income to their total income. There's other lenders who will not include the property taxes, heating costs, condo fees, and take 50% of that rental income and actually subtract it from the mortgage payment. So it's important to deal with a broker because the latter, subtracting it from the mortgage payment, that actually has a bigger effect on what you qualify for. So it's important for whoever you're dealing with to understand those nuances to help you get to where you want to get.
Right. And so that's the advantage of dealing with a mortgage broker, because you are dealing with all of the different lenders who have, as we're learning, very different requirements, right?
Correct, exactly. And there's a lot of them and they change quickly.
So if your plan is to purchase another home and you know that you have equity current home, what is the first thing that you should do before signing a purchase agreement?
Yeah, so you want to be very cognizant of how that new purchase and how that new refinanced mortgage is going to affect your qualification. So it's almost, I would say it's absolutely imperative to get a pre-approval done. Factoring in 2 applications. You're going to have application 1, where it's going to show the refinance amount, the money that you're taking out, and the new payments. You're going to use that information on application 2 for the new purchase. And by running the numbers beforehand, you're going to ensure that there's no issues with the new purchase numbers, no issues from the lender's perspective, because the last thing you want to do is say, I have a ton of equity in my current home. I'm going to go ahead and sign this purchase, and then I'm going to deal with everything else after. Well, what if after we do the refinance, you don't no longer qualify for that new purchase? You just don't want to be in that position. So it's imperative to get the numbers crunched beforehand.
And do lenders look at the numbers differently if somebody is looking to buy an investment property to rent out versus maybe co-sign for their kids versus buying a second resident?
Yeah, so your rate is going to vary based on the use of the property. Most of the time, a lender will add a small premium to their rates when it's for investment purposes. And when I say investment, I'm talking about, tenanted properties. So you being a landlord and renting the property out. If you're purchasing the home for owner-occupied use or for second home use, maybe like you said, co-signing for a kid, those are typically where you're going to see the best rates available.
And in terms of the lender, when they're co-signing, your name would be on title on that agreement, that mortgage as well.
Exactly. It's important to note the difference there. When you're a co-signer, you're actually responsible for the 100% of the mortgage payment as well. So if you have things going on in your life, you might need to refinance on your own. You want to make sure that you're also thinking about when you're co-signing for the other person, compared to being a guarantor where you're only on the mortgage but not on title of the home. There's some advantages there as well. Easier to break, lower fees, don't have to repay land transfer tax. I won't go into the technicalities of it, but yeah, there is an important differentiation to make.
That's great. And is the interest rate for refinance the same as buying your first principal property?
Generally speaking, yes. It all depends on the use of the home. So if you're purchasing a home for your own owner-occupied use and you're refinancing that same home, generally speaking, the rates are going to be identical. The only difference is when you purchase a home, if you purchase with less than 20% down, you're getting those insured mortgage rates, the lowest rates on the market. Whenever you do a refinance, you already own the home. Insured mortgages are only for purchases. So you're not going to see those same rates in that same bucket. But if the home is tenanted and you purchase it as a rental or you refinance it as a rental, then yes, those rates are going to be higher, but the same comparatively.
And I guess the only maybe instance where you could purchase or refinance and have a conventional mortgage on the new property is if you had some of your own cash and you wanted to pull from your existing property to give you a conventional down.
Yeah. So as long as you can get to that 20% figure, whether it comes from equity or a combination of equity and savings or equity and gift, then that's really the differentiating factor in getting a conventional mortgage on the new purchase or a high ratio mortgage on the new purchase.
Okay. So now we have someone and they say, yep, this is what I want to do. I want to refinance. I want to purchase another property. So what are the costs involved for refinance? And what are the things that people would have to look at?
Yeah, so a lot of lenders are very cognizant of this business. Refinance business is, I would say, one of the more sought after, right up there with high ratio, which is the safest kind of mortgages to have. So banks are pretty competitive in the space. Most of the time, you're going to get the 3 major fees covered. That's your appraisal, your discharge, and your legal fees when you switch from one institution to another. That's important to know. If you stay with the same lenders, you're going to be responsible for those fees on your own. But a lot of the time, we can wrap these into the new mortgage request. When I speak of these fees, the appraisal fee, that's generally going to range from $300 to $600. That's the fee to get the third-party appraiser to assess what the value of the home is, to decide how much we can borrow. The legal fee, that's going to be around $1,200 to $1,500. That's your lawyer's cost for amending the mortgage charge with the land transfer board. And then your discharge fee, this one is if applicable. It's if you're switching from one lender to another, you actually have to discharge the existing mortgage. Let's say it's with TD. You have to pay a $300 discharge fee there. And then the registration fee is part of the lawyer fees with the new lender. So now instead of TD as a mortgager, it's going to say Scotiabank or whoever you might deal with.
And so that $300 discharge fee that you're talking about is if the mortgage is coming due. If the mortgage wasn't coming due, or I guess, canceling that mortgage, you would have a discharge fee plus a penalty, correct?
Sort of. If you're switching from one lender to another, that's when you pay the discharge. So even if you're staying with the same lender and the mortgage is coming due, there's not necessarily a discharge fee to stay with that existing lender. It's only when you're changing the mortgage or whoever's giving you the mortgage. But you're right. If you're breaking that early before it comes due, then there's definitely going to be a penalty that has to be accounted for in our refinance numbers, because the last thing you want is, you purchased a home, you've got all your numbers in line, and the one thing you forgot to account for is the penalty. Sometimes those should be, in the tens of thousands.
So you're saying that the new lender may cover the discharge fee, that $300, but obviously they're not going to cover the penalty.
Exactly. I haven't seen it in a very long time where they've been willing to cover the penalty.
That's something that they have to keep in mind. So how do you know if it's in your best interest to refinance your home?
So it really depends on the client's needs. They'll come to us, generally speaking, and they'll say, this is what we're thinking of doing. And we'll say, okay, here's what we need. General income documents. We want to see the existing mortgage statement, property taxes, lease agreements if it's being rented. And from there, we'll determine what they qualify for. Okay, so that's great. Now we know what figure they can get, but does it make sense? So here at this stage in the process, we're going to figure out, what is that penalty? Are you actually coming due? Is this all going to line up perfectly? Or is there going to be a heavy cost involved? And if there is a heavy cost involved, are you saving enough in terms of interest rate for the same mortgage amount for it to make sense? Let's say it doesn't make sense. There's a heavy cost involved. That is really up to the client. So what is the purpose of these funds? We've seen some pretty dire circumstances where the money had to come no matter what it was going to cost. And unfortunately, we just try to lessen the blow. But for other clients, we're like, I'm debating of doing putting in a swimming pool now or versus putting it in next year. Well, we'll break down the numbers. We'll let you know exactly what it's going to cost, and that decision is yours to make.